Pete and I have been going back and forth for quite a few months, and we're finally getting together today on the podcast.
Entrepreneur to entrepreneur is how I always view myself. We are doing is mergers and acquisitions and capital raises for companies in what we've coined the halo sector. If you're going to play this game that's called capitalism, they're playing chess with other people's money and you're playing checkers with your own.
Pete Moore is a managing partner at Integrity Square.
This is Pete Moore on Halo Talks Fast Break 2026. Happy New Year to everyone in the Halo Network. As you know, we are here to help solve loneliness, obesity, and diabetes.
Host of Halo Talks and an M&A strategist shaping the Halo sector.
And what we're trying to do is solve loneliness, diabetes, and obesity.
Were you always in the investment space?
And I don't need to be the guy, holding up the trophy. I want to be the guy behind the trophy. Is this business sustainable, repeatable, and can I go to sleep at night and wake up tomorrow that the thing...
I'm Garrett Wong, and this is the Investing to Win podcast. How do you define success, and what does winning look like for you? Pete, thanks for being on the show.
Pleasure to see you. How you doing, buddy?
I'm doing very well. Audience, Pete and I have been going back and forth for quite a few months between travel schedules and everything, and we're finally getting together today on the podcast. Pete, why don't you give the audience a little bit of background? Not too much because I want to dig in, but sort of a Coles Notes version of who you are.
Yeah, first of all, I don't have a business agent, so I'm sorry it was that hard to schedule us together here.
No problem.
But entrepreneur to entrepreneur is how I always view myself. Right now, I'm the managing partner. I started a firm called Integrity Square, and what we are doing is mergers and acquisitions and capital raises for companies in what we've coined the halo sector, which stands for health, active lifestyle, and outdoors. And that encompasses health clubs, sports complexes, workout recovery, med spas, vitamins, supplements, wellness hotels, corporate wellness. And what we're trying to do is basically be at the epicenter of entrepreneurs that are running businesses that they've proven a concept and they need capital to scale from institutional private equity investors or debt investors, bring executives potentially through our orbit into those companies to help scale and professionalize them. And at the end of the day, what I like to say to people is that if you're going to play this game that's called capitalism, you really need the first 7 letters of that in order to compete. So if a traditional health club operator in Winnipeg, for example, is competing against Good Life or is competing against LA Fitness, you're playing this chess game where they're playing chess with other people's money and you're playing checkers with your own, on the same retail landscape. So at some point, when you get to a certain size, it makes sense to institutionalize your capital structure and start using non-recourse debt, non-recourse equity, so you can preserve your personal net worth, and also so you can pour rocket fuel of somebody else's money on your business once you've said, hey, I've got a prototype. This prototype can move to other markets, and I actually need somebody to help me get there. And I need your capital, I need your guidance. I don't need your operational expertise. So we're kind of sitting in this sweet spot of companies that maybe have multiple locations and $3 million of cash flow, up to about $20 million of cash flow is like the area that we play in, or EBITDA. And we help put those businesses in a pitch deck and a financial model, and then tell them, look, we can help you get capital for your next phase of growth. And what we're trying to do is we're trying to solve 3 things as a bigger mission than just helping people raise capital. We want to try and solve loneliness, diabetes, and obesity. And the only way that you will solve those 3 impactful issues that are chronic in our society today is by finding entrepreneurs in local markets that are providing health services, places for people to have community, places for people to feel good about themselves, to make change, and to get the coaching and motivation that they need. So our target market is only Halo companies. If somebody comes to me with a really awesome energy idea, that's not something we work on. We're strictly focused on our category and run a podcast called Halo Talks. and a business school boot camp called Halo Academy. So we're all in on the word Halo, Garrett.
Wow, there are so many takeaways there. Sorry, I'm taking notes here as the audience can
Sure.
see if you're watching this on YouTube. Loneliness, something, and then diabetes. What was that middle one?
Obesity and
Obesity. Right,
diabetes.
right.
Yeah.
Okay. Let's back up a little bit because this is our first interaction together. I love what you're doing, by the way. Why don't you take us? I don't know. I mean, we're old guys here, but what was your previous thing? What were you doing? Were you always in the investment space? I'd like to hear the origin story.
Yeah, so I'll take you back to let's say when I was 11 years old, because it's an important part to kind of trace back to. Um, I lived on Long Island, and I used to play some team sports, but I wasn't very good at back in the day. One of the reasons why I wasn't very good is because I had access to my father's change bin, and the ice cream man with their ring bell would go up the street every day,
Okay.
and I would go out there and I would take quarters and I would go and buy something called Fun Dip, something called Big League Chew,
Yep.
Twizzlers, candy cigarettes, and I believe those little nerds, those little like sugar
Oh yeah.
nerds. Like,
Yeah.
and I used to hide them under my radiator. And when I went to sleep at 9 o'clock, I used to chug those, take
Oh
all these
no.
down. So
Okay.
I got a little chubby when I was like 12, 13 years
Yeah.
old. Um, and tried out for the soccer team. And when you're tall and you're a little bit chubby, what you do is you try and play goalie because you don't want to run, and you get to use your hands. So I went into goal and actually became pretty good as a goalie, and stopped going to the change bin and the ice cream man and started to work out and play more sports and go to summer camp and became a good athlete. But being the goalie and playing defense in roller hockey and playing third base in baseball, you have a mentality that you're playing defense. And it's not me that needs to win. I just need to make sure that we don't lose. Okay, that was my mentality as a goalie. I'm going to try and keep the ball out of the net, and my strikers and my midfielders are going to be the ones to create opportunities to score. So as I kind of moved forward, I went into investment banking out of Emory University. I was an intramural athlete for the year back in 1993. So I've always been into team sports, but I've always been the guy that isn't the guy that stands up at the end. It's the guy that you thank at the end of the game, saying like, "Hey man, like great save," or way to get in front of that puck. So I've always had a mentality of I want to be behind the scenes and I want to make sure we win. And I don't need to be the guy, holding up the trophy. I want to be the guy behind the trophy. So as that kind of evolved, I went into investment banking because I wanted to learn about finance. And my dad was a business entrepreneur and a CEO of a traditional food service equipment coffee company growing up. Um, so I ended up working at Chase Manhattan Bank, which is now JP Morgan, and a place called Donaldson, Lufkin and Jenrette, and worked with private equity groups on buying businesses. Then went to Harvard Business School, graduated there in '99. Then went to work for an investment fund down in Florida that just so happened in August of 1999 to buy Gold's Gym International. And I was able to raise my hand very high and stand up in a conference room and said, I'm a varsity athlete. I think I should be on the Gold's Gym deal and not the chemicals deal and not the aerospace parts deal and not the janitorial services roll up deal. So I got into the health club industry in 1999 and basically haven't left the industry since. As a private equity investor, then I started up a software company, and for the last 15 years, I've been basically helping people put deals together to bring capital and do mergers and acquisitions in the health and fitness space, which we now have coined the Halo sector.
Wow. Yeah, I can. As you're talking about, I mean, I don't know your age, and I know my age, but yeah, fun dip and nerds and all that stuff,
Well, I'm
man. I
53, and that stuff never had ingredients on it, and there were no
Of
serving
course not,
sizes.
because it was good for you, right?
Yeah, of course. Yeah, the amount of sugar that we intook or intaked as a child
Yeah.
was was borderline, childhood diabetic. I think, if
Yeah.
we look
Well,
back on that.
yeah, I'm 54, so we are
Oh,
the
okay.
same age. So
Yeah.
yeah, it's yeah, what a story. When you talk about Long Island, and I mean, I'm not even going to talk hockey with you because we're from Winnipeg, but Yeah, just the whole investment banking thing, and then PE, and then going into Harvard. I mean, am I to assume in '99 you studied business there, or was it something
Yeah,
else?
I studied business there, and I think the thing I learned at Harvard Business School more than anything, because they teach about companies, and you have case studies. It's not a textbook. Is I fully appreciated that what you put in an Excel model is much harder to implement, execute, and deploy versus when somebody stood over my shoulder as an analyst in a bank and said, "Let's go revenue at 30%." Okay, I'm going to type that in. Let's cut costs by 10%. Okay, let me type that in. And then what does the model say? Well, what is the real world activity inside of a business that actually needs to make that happen? And I got a better appreciation for what it takes to run and grow a business, as well as some of the decisions that you have to make. And it was definitely a great kind of rewiring of your brain. I think is one of the reasons to go to business school or go to law school, is that it really teaches you how to think, teaches you how to ask the right questions. And then when you get into a room, you're much more knowledgeable about the history of business and things that you've seen before. Somebody once said, to digress, in a history class, why are we learning about the railroads? Like, the internet is what we should be talking about. One of my cohort peers said, and the professor said, let me tell you something. What happened with the railroads is going to happen with the internet. Okay, it's the same pipes that are being built. They're just being built for digital instead of physical, right? And if you see what happened with the consolidation of the railroads and some of the business decisions that needed to be made, and the amount of capital that was put into that, and who the winners and who the losers are, you can actually learn a lot by understanding how the railroads were built. And then you'll understand how the internet pipes are built. So I think business school, some people might say, well, what's the return on investment of dropping out of, the earnings, market, and repositioning yourself. I just think if you have that opportunity, you're going around the sun only a certain amount of times, maybe 90 years, hopefully, or
Hopefully,
less, right?
yeah.
You can take two of those 90 and actually, apply your brain to like learn as much as you can. So I really enjoyed that experience.
Yeah, no, it's amazing. Morbid curiosity, if you don't mind spending a couple
Sure.
minutes on it. Gold's Gym. Um, Whatever happened to it? Like, did you guys do a more of a roll up with that, or I'm just
It's a
curious because
great
I
question.
I know what it was back then because I was obviously pumping iron back in '99. But yeah, whatever happened to Gold's Gym, or is it still around?
Yeah, it's a great story. So the private equity group that I worked for down in Florida, called Brockman Rand and Partners, what their goal was to do was to buy corporate locations, so they would get more bricks and mortar and EBITDA, cash flow, from
Yeah.
certain regions, and it was to try to not tinker with the franchise business. So if you were a Gold's Gym licensee back in the '80s, and the movie Pumping Iron with Arnold Schwarzenegger was out,
Yeah.
the reason why Gold's Gym was licensed, as a history buff, the reason why Gold's Gym became a club in San Francisco, and became a club in New York, and became a club down in Texas, and in all these other markets where they had over 500 US locations, is because back in the day, they, people would not sign up for a membership unless they knew that a club would open, because there was a lot of nefarious activities going on where people would take a building and say, I'm building a health club, and they weren't able to collect any dues or any membership, prepaid memberships prior, because people didn't believe that the club was ever going to open. So before there was bonding of memberships where you can't collect money before you actually open a facility, a lot of entrepreneurs wanted to build a gym and wanted to sell 1,000 memberships to help fund the construction. Well, the best way to do that would be to get a recognizable brand in order to help you sell that. And then the states kind of got wiser and said, you're only allowed to collect that membership if you have a fitness facility. So a lot of guys would rent like 3,000 square feet, or have like a trailer where it had some treadmills and it had some strength equipment, so I could sell the memberships. But quite frankly, Garrett, they were using that money to try and build the rest of the club. So Gold's Gym kind of proliferated because I could get the Gold's Gym brand that was now pretty well known because of Arnold and because of Venice Beach. I could get that for like $25,000 and like $500 a month. I could license the Gold's Gym brand. So it was never a franchise. So when the Brockway Moran private equity group partnered up with the Galliani brothers, which were the largest franchisee out of DC, to buy the franchisor, they were trying to professionalize the organization. And then we're trying to add a royalty and franchise model into the system, which kind of was slow going because a franchisee who's paying $500 a month doesn't want to now pay 6% of their revenue to corporate. And they'll say, well, what are you giving me in order to take that much of my revenue away from me? So Gold started as a license. And what happened over time is a lot of the groups that had multiple locations, such as a group called Brad Nesty and Wanda Nesty down in Arizona, had 17 clubs. And 10 years ago, we sold those 17 clubs to a private equity fund that rebranded it to something called EOS. There was a group out of DC that had 50 clubs, got rebranded to One Life. There's clubs in Wisconsin that got rebranded to Experience Fitness. There are clubs in Connecticut that got rebranded to The Edge. So as you looked at all the different states, they said, why am I paying, or why am I going to potentially renew my Gold's Gym contract? And they end up de-identifying, paying the corporate that was a new buyer that actually wanted to get back territory so they could build back corporate locations. And the brand basically like lost its market power in the US. Internationally, they're still selling franchises like it's 1984. So if you go to the Middle East, you go down to Brazil, you go to Asia, there's Gold's Gyms that are growing because people know Gold's Gym is basically, a US American brand and an icon like Harley Davidson.
Wow. Wow, that is quite a story. Yeah, no, I was gonna talk about EBITDA. I mean, I think everybody kind of knows what that is, but you gave numbers that you work with firms in the $3 to $20 million range. When you're talking about the Halo space, again, I'm referencing notes, supplements, and health clubs and things like that. Do you find that you're naturally working with bigger operators in the Halo space? Because I mean, 3 to 20, that's not just a mom and pop shop.
Yeah. So, there are different times when you want to be an investment banker and you want to help people put deals together. And given I told you my background of working in larger banks before I went to business school, my relationships were all with private equity funds that were investing in lower to middle market companies. If you want to come to a venture capital group with an idea, and let's say you want to start up a new supplement or you've got a new creatine and protein combo mix that you're putting together, and that's just an idea, venture capital firms don't want to pay intermediaries or brokers or bankers to help facilitate those introductions. Whereas private equity firms actually prefer when an entrepreneur has a banker because it's somebody who's going to tell them during the deal, this is fair, this isn't fair. This is how the contract works. These are what the economic terms are. These are the adjustments that we're going to make. This is your employment agreement. This is how much equity you're going to have. So a banker with a middle market company that's got at least $3 million can attract private capital. If you're below 3 million, you might have more like key man or key woman risk where someone's like, am I investing in a person or am I investing in a business? And the hardest thing to do is invest, in a person when there's no real assets behind it. There's obviously plenty of cases where somebody would say, I invested in the jockey, of this horse, and I'm like relying on them to make decisions and create a business. But private equity is not looking to take speculative risk on your idea. They basically want you to figure out your idea, show me that you've done 3 to 5 health clubs and that you've scaled it and that prototype is replicable across different parts of Winnipeg, and you went to Calgary and you went to Toronto and they all work there. Now you want to build 50? Okay, I'll get you the money from an investment group that will buy into your strategy and it will basically give you the capital to do that. Below 3 million, they might say, hey, maybe this is like location specific. Show me that there's a real platform. Is the term that people use as a platform acquisition. Um, but there's plenty of cases where private equity groups will say, "Hey, I'll back you, Garrett, in a roll-up strategy because you've
Yep.
done something prior in the industry or in a similar industry, and they believe in you." But mostly believing in an entrepreneur is what we call venture capital, which I joke around because I've made several venture investments. I call it adventure capital because it's an adventure and you don't really know what's going to happen or if you'll ever get your money back.
Yeah.
So that is definitely more speculative. But private equity is not trying to take risks. They're trying to provide you with rocket fuel, as I like to say, to take your business from where it is and then repeat it.
Right. And I mean, I know a little bit about the private equity space just because I've been so interested in it. I think I said in the green room, I'm also interested in doing some roll ups. But I mean, I'm in the property management real estate space. So my thing is not necessarily Halo, it could be service companies or things like that. Do you find, like, what are the multiples like in the private equity Halo space when you're talking, let's say around the 4 or 5 million EBITDA?
Yeah. So if it's a lot of it depends on how much growth you have kind of like ready to be built or already kind of in the ground. But the metrics right now are basically if you have $3 million of club level or studio level EBITDA, you're typically going to get a multiple of anywhere between like call it 5 to 6 times that club level EBITDA. And private equity firms will actually give you a higher multiple, and I'll explain why in a minute. But if you wanted to sell your 5 clubs in Winnipeg to Good Life or to an Orange Theory or a Planet Fitness, they might say, I could go and build a club, right? It might cost me $2 million, and I might get my money back in anywhere between 3 to 5 years, is how the math would work on that. So would I rather buy you for more than the 3 to 4 times that, or 3 to 4 years? And for your audience, when I say a multiple of EBITDA, that's basically the cash flow that I'm most likely going to generate in the year after I buy the business. So if I get your business and you stay on as a CEO, Garrett, and we make $3 million, I might buy your business for 15 million or 5 times that. And I hope that that 3 million is going to continue to perform. Plus, I hope that it goes up over
Hmm.
time. Now, if I'm a strategic buyer, I might say, hey, I'll pay you 15 million for that because it's going to cost me $15 million and a lot of resources to go and build 5 clubs in Winnipeg. I could borrow money, half of that to buy your business from a bank, and I could put 50% of my private equity capital in, and the investment will work out if we add more locations, to that cluster. So that's kind of the basic math of multi-unit operations. Now, when somebody gets a hold of a Planet Fitness franchise or an Orange Theory pre-COVID, the unit economics, which is really what this is all about, how much money do you make inside the 4 walls of your club? If those unit economics allow you to get your capital paid back, if I build a Planet Fitness, it might cost me $2 million to build a 20,000 square foot location. If that does $700,000 in cash flow, which it will, for 3 years, I get my money back in 3 years. So if I'm a private equity investor, I'm like, wow, that's like basically building me a cash register in Winnipeg. I'll
Right.
take that cash register and I'll give you more money to build more cash registers. Um, Now, is Planet Fitness going to generate 700 or 800 or 900,000 per unit? Depends, right? It depends on, are they going to innovate? Can they raise prices? What is the competition that's going to come in? Are they going to add personal training? Are they going to add group exercise? Some of those things might sound like, oh, that's easy to do, but it comes with cost, and you're taking your eye off the ball and you're changing the business model. So that's like kind of the tops of the waves on valuation. But there are some groups that might say, um, there's like one of these dessert places that does cookies. I don't know if you have them up in Winnipeg called Crumbs. It's like one of you buy like like these big cookies, that like
Right.
have all different stuff in it, and a lot of sugar, like back on the Fun Dip days. You might have a store or Insomnia Cookies. You might have a store that's 500 square feet, and it might generate $500,000 of cash flow. And somebody might say, hey, I think this concept could be in 1,000 locations, franchise or company owned. I might give you a 15 or 20 times multiple on that because I see the growth, and it's not going to be hard to find 500 square feet, in every city across the country with this new concept that is coming out. But as you do private equity deals, you see that some of these things work exactly according to plan. Some of them get sold at higher multiples and go public. Some of them are like, man, they just missed it. Like there's a group that's in the workout recovery space that had 400 locations. And I told everybody, cold plunge sauna, cryotherapy, infrared, IV drips. I'm like, this company's going to crush everyone because they got 400 locations. They're going to be the next Planet Fitness of workout recovery. And it didn't go according to plan. And they had operational issues. They had inventory, supply chain issues. They had franchisees that couldn't figure out the model. They had some medical compliance issues of like, you can't stick a needle in my arm unless you have a physician's assistant or a doctor on board. I might need a medical director in a certain state to do certain things. I have to staff the place with doctors and high-priced anesthesia, estheticians. So, not everything's a slam dunk, but you can see different waves of private equity when they get behind, the med spa space, or I get behind the health club space, or I get behind vitamins and supplements. Who thought that gummy bear vitamins, would be as big as it is, or creatine gummy bears? That's like a whole industry on it in and of itself. You can eat those like Tic Tacs.
No, like I said, I have a big interest in private equity and roll up specifically. So I guess my next logical foray into that is when you're talking about an actual roll up. Okay, so we're not just talking about, hey, I've got a few clubs and I'm generating 5 million of EBITDA. In terms of rolling up things, like to me, you've got your platform company, you've got your portfolio companies. When I think of that as the plumbing space, I've got a really big plumbing company. We're integrated. We've got software. We've got CRMs. We've got all these things, and we're buying up Bob's Plumbing. We're buying up Steve's Plumbing. What does that look like in the club space? Because clubs are not, again, usually not a mom and pop, unless it literally is somebody who's renting out 400 or 500 square feet of space. Are they rolling these up, or is it not really? You don't see that in the Halo space.
Yeah, you do. You do see, it started off with a lot of franchises and licenses. So the first wave of growth in the health club industry, besides Bally's, Total Fitness, and then LA Fitness, and then Lifetime, were all independent operators who took the Gold's Gym brand, World Gym, and Powerhouse. Those were the three kind of first evolution of licensing and franchising. And what's happened over the last 5 years post COVID is that a lot of those owners are now in their 60s and 70s, do not have any kids that want to be in the health club industry. And now they're looking to sell, and they don't really feel like taking on a private equity partner. So there's a lot of consolidation that just started and is going to continue for the next 3 to 5 years, where the larger private equity players, based on the math I just went over with you, are going to say, if I could buy these clubs for 5 or 6 times cash flow, if I buy something for 5 times cash flow, and that cash flow stays the same, it doesn't move. Let's say I have operators that could keep it at least 5 million, then I get a 20% return on my investment. If I put down $5 million, make $1 million a year for 5 years, right? I make 20% return. If I'm running a private equity fund, I need like a 25 to 30% return is great in this market to be able to continue to get more money. So if I'm a private equity firm and you and I start up, Moore and Wong Capital Partners, okay, we get $100 million from the Ontario Teachers pension fund, and CalPERS, which is the California fund, and Emory University, because I went there, and your school, and we got $100 million, and we turn that $100 million into 200 over a 3 to 5 year period. We're going to get another fund, and we're going to be able to raise more money, and that's how you and I are going to live and be able to afford the Uber SUV instead of like UberX, and maybe stay at the Marriott instead of staying at the at the Red Roof Inn. So
Right.
And the private equity groups, they get paid based on generating returns and promotes and asset management fees. So there's a lot of alignment between an entrepreneur who takes on capital and the people that put it in to say, hey, if we double the size of the company, you're going to make a lot of money. I'm going to make a lot of money. My investors are going to make a good return. and I could probably do this and continue in this private equity career.
Yeah, no, it's really interesting because to me, I mean, I'll ask another follow-up question then. Like PE, private equity in the Halo space, when they're buying up these companies, at least in my, and I haven't done a roll up, I don't actually have any contacts in private equity other than, people that I know of. When PE comes in and buys, let's say, a health club, you mentioned, okay, somebody's staying on as a CEO, but typically, if they're rolling something up, that operator doesn't have the chops to really do that. And then normally, in my experience, a firm will come in and they're going to kind of run that, and they want to move that up to the next level, so a bigger PE firm can give them their multiples. Does that happen in the Halo space?
Yeah, yeah, it's happened, and it's going to continue to happen. So Solid Core is a good example of that, where there was a late stage venture capital or early stage consumer growth fund called Peterson Partners. They did a deal where they were the original investor in Solid Core, funded the growth of the first set of Pilates studios. Then another group came in called VMG Capital, which basically poured additional rocket fuel onto the unit growth during COVID. And then it got sold to a group called Kohlberg and Co., which is another private equity fund. And then it subsequently got sold to a larger PE fund recently. And everyone made money along that private equity road. But to your point of like who's the buyer of the business when you're done with the consolidation, the buyer of the business is most likely another larger private equity fund that is trying to have a smaller private equity fund. If we really want to like break it down, what a small private equity fund is doing is basically like cobbling together, and like you and I are like creating the platform, which is hard to do, right? Because we're dealing with entrepreneurs who've never done a deal before, might not even know what their EBITDA is. Their friend might say, "How can you sell this thing for less than $2 million?"
Right.
This thing's it's got to be worth at least 10. It'd be like, "Where'd you
Not
get
to
that
mention,
number from?"
not to mention tons of owner comp in the books, right? So
Yeah, they got owner comp. I got like they haven't invested $1 in the club in like 10 years.
yeah,
But they're like, "Look, I got this great lease. Oh shit, I forgot to renew it." But like, yeah, it's like, okay, like I got to buy like a business that's continuing.
yeah,
Um, so you got to so you go around, you try and create the platform in any industry, and then once you consolidate enough, and you have good management that says, "Okay, I know how to roll in and absorb and integrate businesses." Some of that might be I'm going to put the brand of like Service Master or Serve Pro on the door, or I might just run a company that has, if you're looking at the plumbing services, it could be, Wong's Winnipeg Plumbing, and it could be, Pete's Arizona, unclogging business. We might just say, why would we even touch it? Let's just keep the names out there because people know them in the local markets. But I could put them under one roof and say, hey, I've got a consolidation of a house of brands in the home services space. And then hopefully somebody is going to pay you for the work that you've done and the value you've created to say, I've got the plumbing services, I got landscaping services, I got alarm, I got locksmith, and I got housekeeping or cleaning or roofing or whatever, right? And now another private equity firm might say, hey, look, that's awesome. Like maybe I'll pay you 8 times or 10 times for that platform. And that's how a private equity firm would get a multiple expansion or arbitrage, as we would like to call it,
yeah,
in a worst case
absolutely.
scenario.
Yeah, and I was going to say, I have heard, again, this is hearsay on my part, that trends are moving in a very good direction in private equity, meaning for the layman, there's too much money and not enough companies to buy. Is that accurate?
Yep, that is accurate. People like to say that private equity, institutional capital is smart money. I don't know how smart it is at times, but they do have an evaluation lens that if you're not a profitable business, and you say you are, going through a diligence period will weed out companies that aren't worthy, or the business just isn't cash generating what has been presented in those financials. So yeah, there's definitely more private equity groups. When I started this job, Garrett, there were 30 private equity funds back in 1996. And I used to run around, New York and go to their offices and pitch them ideas before the internet. Hey, what do you think about this alarm services company? It's owned by this family, and I happen to know that, they're looking to get out of the business. Like, oh, that's awesome. But now there's like 300 private equity firms that would love to do that deal,
Hmm.
and the seller of that business is no longer going to have a conversation with one private equity fund. They're going to call up somebody like me or call up an investment bank and say, hey, can you shop my business and run an auction process to get me the best price and the best terms? And now it's no longer a great deal because whoever wins that auction just paid probably last dollar
Yeah.
for it. So when you win an auction, sometimes you lose because you probably overpaid by whatever amount the market was at. At the same time, if you're an operationally focused private equity firm, then the argument would be, I know that they're doing some things that I don't think are, the best, the most efficient way to do it. Or they do international sourcing, but they don't have anybody on the ground like I do. Um, they should be buying their competitor, but they didn't have the money to do it, so I'm going to go do that. So private equity brings like a big, powerful weapon, which is capital, to the table, and you can't get that without giving up a percentage of your company or selling your company to get that benefit. Doesn't make
Yeah.
it all smart; it just makes it private equity.
Yeah, no, that's a thought went through my head when you're talking about, like, we've been just discussing a lot of health clubs, but you mentioned things like supplements. I'd like to hear your view on supplements, specifically. Like, to me, supplement companies, assuming that they get into that $3 to $20 million EBITDA range, are largely, are they not startups? And if they are, where is that line that PE will cross before it's no longer venture capital, and it's like, okay, this is a bona fide company, we can actually sink our teeth into the EBITDA, they're going to be around a long time. Do you Am I inaccurate on that?
Well, the term venture capital and private equity, kind of hit a gray area in the middle of those two terms. Because if I've got a company and let's say it's been around for 5 years, and I've been able to show you, hey, I started my supplement company with some distribution inside of GNC, let's say. Then I got into Walmart. Then I got into Walgreens. Then I got into Costco. Then I got into Lifetime Fitness, and I've got repeatable business going through different channels, and also I'm doing X amount on Amazon. I'm doing X amount online, like AG Greens. I don't know if you know Athletic Greens, right? They like to have
Oh,
these
yes.
packages. Billion
Yep.
dollar company.
Yep.
Yeah, they got funding like a year ago or 2 years ago for like over $1 billion. So at some point the revenue is big enough and the distribution is large enough, as well as the actual trailing revenue and channel partnerships and marketing, that you're buying an engine, and that engine is now a proven engine that returns a certain amount of revenue and results for marketing, like Red Bull is a good example, or Monster drink beverages,
Hmm.
right?
Yep.
So at some point you say like, okay, that's not a venture anymore, because I'm not taking a risk that the business is going to disappear. Obviously, competitors could come around any day and try and clean your clock with a better product at a lower price, which you see a lot in like the energy drink market in general, with some of these new energy drinks or celebrity drinks that come out and then disappear, pretty quickly. Um, but private equity would say, is this business sustainable, repeatable, and can I go to sleep at night and wake up tomorrow that the thing didn't fall off a cliff, and I just didn't see that happening.
Right. No,
Yeah.
it's like I said, I just find the whole thing really, really fascinating. Um, when we're talking about, like, let's move back now. I mean, integrity squared. What was your motivation in starting the firm?
My goal was to try and help bring in more capital to entrepreneurs and friends that I have known in the space for a long time, because I saw that there was a need and an ability to grow these businesses, and I was able to be this connector between capital and entrepreneurs. So I've always wanted to. I get excited about putting deals together. I'm a deal hunter, and that's what gives me joy. I'm not a gambler. I don't like have fantasy football team. Like, I like putting deals together. Like, but business is my hobby. Um, but we found a niche small, and it's growing, and we're just like sticking to what we do. And I think that's a lesson for anybody on this listening to this. When you find something and become a specialist in it, and you become an expert, um, that's where you really become like an authority in what you're doing. And I've had friends of mine who like spread themselves too thin and or have their hands in a lot of different things. And I've learned through experience that have your hands, both hands in one thing, and push yourself and be present. And that's where the benefits come, career wise and also relationship wise and network wise.
Yeah.
Hey,
Go ahead. Sorry.
hey, I've got. Is there any way we can continue this? Because I got one important call that I got to be on for a client. That'll take like 15 minutes.
Yeah. Let me
Do you
see
want to?
here.
Or can we? Like we're at like 30. I think we're at like 35 minutes.
Yeah,
Can
we're
we? Can we do
39.
like a second? Yeah. Can we do like a?
Sure.
Could
Yeah,
could,
we
could
can
we
do that.
could we reset this? Or how's like what's your day like? What's your rest of your day like or night tonight? Or
Yeah, I'm good.
what's good for you?
Yeah, you know what? Let me see what happens. Let me stop this.